All right, so chapter 4, we're going to get into several things. We'll really get into the meat of tax, starting in chapter 4, and how to determine certain things about an individual's income, taxable income, deductions and things like that, filing status, exemptions. So this is really where the good stuff starts. So it starts out with the individual income tax formula. This relates to individual taxpayers, not companies, not partnerships, not corporations, but it does relate to sole proprietorships, okay? Because when you are a sole proprietorship, you must schedule, and what you do is you add a what they call a Schedule C, which shows your business income and expenses. And then that bottom line number, the net income from business gets transferred over to the All right, so looking at this formula, gross income minus what we call core AGI deductions. AGI means adjusted gross income equals adjusted gross income. And then from adjusted gross income, you deduct AGI deductions. There are two main types. Either a standard deduction or a taxpayer's itemized deductions, whichever is higher. And then on top of that, you also deduct personal and dependency exemptions that you might have. And so after you deduct either standard or itemized deductions and personal and dependency exemptions, what you come up with is taxable income. So that's your basic income tax formula for an individual. Moving down, so you have your taxable income, and what you do is you multiply that taxable income by tax rates. As we saw, the tax rates are graduated. In other words, it's not like you just pick a flat rate of your tax rates increase as your income increases, and income up to a certain level will be taxed at a certain percentage, and then above that certain level taxed at a different percentage, and so on and so forth. So the taxable income times the tax rates equals income tax liability. Then you might have other taxes such as self-employment taxes. That's a possibility if you are self-employed. And there's some other taxes, but that's usually not a problem for most people. And so you add the income tax liability and the other taxes together to come up with total taxes, and then from that you subtract any credits, dependent child credit, student loan payment credit. I think there's some others that we'll look at. Also, you deduct your prepayments. For most people, employees, the prepayments are the amount that's taken out of your paycheck by your employer. And so what's left is the amount of additional taxes you owe, or if you've overpaid, with your prepayments and credits, then you get a refund. Okay. So that's the bottom line number that you're looking at. But I mean, this is your total tax right here. So you're just taking away from that with these credits or prepayments. If you're self-employed, you are required to make quarterly payments, so there should be prepayments from there as well. Individuals report taxable income to the IRS. Normally it's on 1040, although there are some variations of the 1040. There's the 1040A and the 1040Z, I believe. Most taxpayers report on just standard Form 1040. Now, as you note, the starting point to figure out an individual's tax liability starts with gross income. Well, what is gross income? Do I have gross income? I buy a stock and that stock appreciates in value, but I don't sell it? Well, no. What tax law considers income is when there's a transaction that changes ownership interest of a taxpayer, between a taxpayer and a third party. And so only until the taxpayer sells that stock will there be any income or loss. So income certainly is those things that you consider, such as wages, sale of property, things like that. Now you have to boil this down to looking at all income, because indicate that you must include all income from whatever source derived. And we'll look at this deeper in the future, but it's the all-inclusive method. And so you start with realized income, and from real income you determine explicitly exclude or put off tax recognition, or income recognition, I should say, until a later date. And explicit exclusion or deferral of a particular type of income, if there's not an explicit exclusion or deferral, then you have to include it in gross income. Okay. So, I guess the difference is real income and the income, but if it's specifically excluded or deferred, then it's not recognized income for tax reporting purposes. Not excluded or deferred, then you also have to recognize that income for tax purposes. Now, the other thing you have to consider when you're talking about income is the character of the income or loss. And so why does it matter what the character of the income is? Are taxed at different rates, and in many cases favorable rates. For instance, tax-exempt income is, as the name infers, taxation. City and state bonds, the interest earned on it is not taxed. You might have tax-deferred income. If that's the case, you have some future tax year. So, again, the character of the income has to be looked at. Most income is considered ordinary income. Certainly, wages are certain dividends from stock, things like that. A lower rate. So the character of the income has to be considered to determine whether or not it's taxed at all, if it's deferred, or taxed at either ordinary rates or a lower rate. Another type of and character of income gains the sale at a preferential rate, a lower rate than ordinary income for taxpayers. That rate is either 0, 15, or 20% depending on the taxpayers. So, very important to look at the character of the type of income received. True of losses as well. If you have a capital loss or a loss on the sale of a capital asset, is probably a better way of putting it, then you get to do certain things with that capital loss. We'll talk about what a capital asset is versus other types of property. For capital property, it depends also on how long you hold that asset. If you hold it for longer than 1 year, it's considered a long-term capital asset. If it's held for less than 1 year, short-term, and there's different treatment based upon long-term. Rates, not short-term capital assets that are sold. And so capital assets are defined as all assets except accounts receivable, inventory, assets used in a trade or business, including supplies. So what's a capital asset? Your card that you use for purchases is a capital asset. You probably didn't even know you had to include that in income, but yes, you do. Now, most cars are sold at loss. Once in a while, you might into ownership of a capital asset that's a gain asset. Certainly, stocks are considered hold is stocks and bonds. So capital assets is pretty broad. Capital assets also includes a personal residence. So residence income tax. It might not. It depends. I mean, there's some exclusion rules concerning the sale of a principal residence that, for many people, exclude the whole amount of any gain. We'll take a look at that in Chapter 14. If you have, through the sale of capital asset, long-term capital gain, that net capital gain is taxed again at either 0, 15%, 20%, depending marginal tax rate on their ordinary income. So that's a preferential rate as compared to the ordinary tax rates. Note here that short-term capital gains are taxed as ordinary income. So there's no preferential treatment for buying and selling property for a year or less. If you, let's say you sell one or more capital assets and you have a net capital loss, that would be losses that are in excess of your gains from the sale of capital assets. That's going to happen when you have the sale of multiple capital assets. What you get to do with that net capital loss is you get to take $3,000 of that loss and you get $1,000 against ordinary income. Any loss that remains in excess of the $3,000, you deducted from ordinary income gets and used in subsequent years. All right, so once you what you're then you have to figure out your deductions for AGI. And if you look at a Form 1040, such as the one on page 3 of Chapter 4, the page 1 of the Form 1040, what you see here is you have certain sections, you have your name of the taxpayers, filing status, exemptions, income section. You have all these different types of incomes. Notice here you have to report tax-exempt interest, although you don't include it in reportable income, which is kind of weird since it's tax-exempt, right? But they make you report it. You just don't include it in taxable income. And there's some other things in that income section that we'll talk about in the future. This is just kind of a basic talk. Then you get down to the adjusted gross income section, and that's where we are. Lines 23 through 37. And so these deductions are called above the line being line 37, adjusted gross income. And so these items, lines 23 through 35, really, are deducted from total income to come up with adjusted gross income. And so these reduce your taxable income dollar for dollar. What we'll see with itemized deductions is it's not a dollar for dollar reduction. Here it's a dollar for dollar taxable income reduction. If you look at the character of the type of deductions for AGI, most of them are employment related somehow. Educator expenses, business expenses of reservists, performing artists and fee basis government officials, health savings account deduction, moving expenses, deductible part of self-employment tax, etc., etc., etc. Probably there's a couple of things in here that are outliers down below. Certainly alimony that you pay is not work related. And there's some others in there that we'll talk about. Deductions from AGI are considered below the line, meaning they're considered after determining adjusted gross income. And so these are deducted from adjusted gross income to determine taxable income. Again, it's for deductions, it's the greater of standard deduction or itemized deduction. And if you look at on page 9, you get a list in Exhibit 4-7 of what the standard deduction is. Note that the standard deduction only went up for head of household. The standard deduction remained the same for 2015 and 2016, which is kind of odd. Normally, the deductions go up every year, but didn't happen this time. And head of household only went up $50 from last year. So that's kind of weird. So you would, if your standard deduction, let's say you're married filing jointly, and your standard deduction is $12,600, the only time you would use itemized deductions is if the itemized deductions, the sum of all those itemized deductions was larger than the $12,600. In application, for the most part, most taxpayers are not going to be able to itemize that great of an amount or higher than the standard deduction. In my experience, the only time that happens is when they own a home and they're able to itemize their mortgage interest as a deduction, as well as property taxes on the home. Especially in the first several years of home ownership. I mean, in the first years of home ownership, the main part of your house payment is interest. So you get to deduct all that interest up front. So, but if you're not a homeowner, more than likely you're just going to have to take the standard deduction. And then after the standard deduction, or itemized deduction, whichever is larger, you look at your personal and dependency exemptions. Now, the personal and dependency exemptions for 2016 is $4,050 for both types. And so the reporting taxpayer would get an exemption of $4,050. If they're married, their spouse would get $4,050 personal exemption, spousal exemption, and then each dependent also gets $4,050. So, I mean, between, especially for like a married couple, between the standard deduction and dependency, personal and dependency exemptions, so you got a married couple with 2 children. I mean, you're going to wipe out and shelter over $16,000 just from the personal and dependency exemptions. And then on top of that, you get another $12,600 from the standard deduction, or if itemized deductions are higher, that figure. So, I mean, you get to shelter from tax, just off the top of my head, a good almost $30,000 of income. So there's the figure for standard deduction amounts. One thing we'll talk about in Chapter 6 is if you are over a certain age and or blind, legally blind, you get additional standard deduction amounts. Again, when figuring out the tax, what you come up with is AGI minus these deductions and personal exemptions. You come up with taxable income. That's what's left over. And so we use a progressive tax table. You can look at, well, they used to in the front and the back of the book have these tables. I'm not sure what they did with them. Hopefully it's in your book. I know that we have a tax table somewhere in here. I will find it and let you know. Well, it's I'll find it. Okay. So you know, if you're using a software, obviously this does it for you automatically. You know, certain amount, the income up to a certain amount is taxed at 10%. Then a certain amount above that is taxed at 15%, and then a certain amount above that cap at 15% is taxed at 25%, and so on and so forth. Again, certain items are included in taxable income. To consider the amount of tax you pay for those preferential items, such as long-term capital gains, qualified dividends, and some other things. Now, if you recall, there might be some other taxes that you have to include. Normally, this doesn't happen if you're just like a working stiff like me and you don't make a ton of money like me. You're not going to have these other taxes, but you could if you're either taking lots of deductions, itemized deductions, you're self-employed, or you're just a high income individual. So for those who take a lot of deductions, there's this alternative minimum tax. There's a self-employment tax if you're self-employed. There's the 3.8 net investment income tax if you have lots of investments and you make lots of money, and the 0.9% additional Medicare tax if you have income above a certain level. After you include all the taxes that you owe, then you get to take tax credits. These are reductions in your tax liability dollar for dollar. There's a child care tax credit. I think there's credit for educational expenses, stuff like that, that we'll look at, that reduces your tax liability dollar for dollar. And then, of course, if you've made any prepayments, You get to deduct those in determining whether or not you still owe more taxes or if the taxpayer should receive an income or a refund, excuse me. All right, let's see here. And again, personal exemptions for taxpayer and spouse, if married filing, they get each an exemption. If they have dependents, then again, you have to qualify a particular person as a dependent. We'll talk about that in length. Each exemption gets $4,050. You get to reduce from AGI for each exemption $4,050. All right, so we're going to stop there. We'll pick it up on the next round of lectures talking about exemptions, because that's a pretty lengthy discussion.